In Chapter 8, we're going to look at the accounting for long-term assets. Long-term assets are simply assets that last on our company's book for any period over a year. Typically, these are things like our property, if you have land, plant, if you have a specific manufacturing plant, or any type of machinery. That could be computers or machinery that actually works in your manufacturing plant. So, as we move forward, we're going to look at the accounting for these types of items. When we account for long-term assets, there are typical things that we have to look at. First, we're going to discuss how do we assess how much an item should be on our books for. And that can be a complex thing to answer when we're talking about long-term assets. Because these assets are more expensive and they're generally more cumbersome, there are additional expenditures that are taken into place when we purchase these assets. And what we'll find when we look through the next couple of slides is that those expenditures go in to the cost of those assets on our books. We're then going to look at depreciation. Depreciation is simply how we recognize the fact that when we have something and we are using it in our business, the value of that item declines over time, and that's simply because of wear and tear to the item. It's no longer as useful as it was when we first purchased that, and we recognize that decline in value through depreciation. We'll then, along the same lines, add two other terms, and we'll call those depletion and amortization. Both of these are very similar in depreciation because they are recognizing the loss of value over time. However, for certain assets, rather than depreciating them, we simply use a different term, and that's either depletion or amortization, and we'll define what type of assets use what as we move forward. Then finally, we're going to look at, once we're finished using an asset, how do we get that asset off of our books? And to answer that question, we have to take the value of that asset off of our books, so whatever it was originally on our books for. And then, as we have accounted for depreciation over the past years, we have accounted for something called accumulated depreciation, and that's a balance sheet item. We'll look at that as we move through these slides. But when we take an asset off of our books, we have to take off everything related to that asset. So we have to take off the original cost of that asset and any related accounts, which in this case would be your accumulated depreciation. Finally, we'll look at a couple key ratios, and that's what we're going to do as we go through Chapter 8. So first, let's begin with cost determination. This is what I was saying when we're talking about these larger types of assets. There's a lot of costs related to purchasing these assets. So all of those go into the value in which we put these items on our books. So when we're talking about these types of long-term assets, we've got some examples. First, let's talk about our plant assets. Anytime you're talking about a plant, you're talking about a manufacturing facility, a manufacturing plant. So the assets in that plant would be your actual equipment, the items that build whatever it is you make. If you have any types of trucks or cars related to that manufacturing plant, computers, things like that, the building that everything is in, all of those are your plant assets. They are tangible, meaning you can touch them. They are actively used in our operations, and we expect to receive future benefits from these assets. What we mean by future benefits, meaning that because we have purchased this plant and all of the related equipment and things like that, we expect to be able to create our product throughout the next couple of years, and that would be the benefit that we expect to receive. And we call all of these things our property, plant, and equipment. As I mentioned, with property, plant, and equipment, we have to understand that the value of something declines over time. So here we just have an example. You can see an example of just a building. And this is what the building looks like on day one. It's brand new and it's clean, and the value is at the highest at this point. As soon as you buy something, that value begins to decline. In your personal life, you might hear of depreciation when you talk about someone buying a brand new car. And we all know that when you buy a brand new car, as soon as you drive that car off the lot, the car depreciates a significant amount because it's no longer a new car. There's some type of value that has been lost. So what we're doing through depreciation is we are recognizing that loss in value. If you'll remember a couple chapters back, we talked about the matching principle. And remember, the matching principle states that we want to recognize expenses by matching them or recording them in the same period with the revenues that they help to produce. So the expense of depreciation needs to be recognized throughout the year as these plant assets are helping us to produce revenue. And then getting back to our picture here, you can see over the life of this asset, we see a decline in value, and you can actually see this decline by seeing that the building's getting older, things are getting worn down. You can see there are some things that are broken, just to pictorially represent this decline in value. So when we're talking about accounting for plant assets, there's three main things that we need to account for. There can be other things here and there, but these are the three main things going on. First, we acquire the asset, and along with that, we have to compute the asset's actual cost, and that's what we're going to get into next. Then we have to account for the use of that asset. The more we use an asset, the more wear and tear it gets, and therefore the more quickly it will get worn down. So we have to take our understanding of how we plan to use a particular asset to help us have an understanding of how long do we think this asset will live, or although an asset is not truly alive, we mean the accounting life of it. So we have to determine how long that asset will be of use to us, and that's how we begin to be able to calculate our depreciation. And then finally, we need to account for the disposal of that asset, and that's part of what we'll look at the very end of this chapter. So moving forward, we need to talk about how do we determine the cost of an asset. When you first think about this, it may seem very simple. You purchase a building for $100,000, so wouldn't that be the cost of that asset? But the truth is when you're talking about complex, large, or expensive assets, there are other things that come into play that we will add to the cost of that asset. And the general rule here is all expenditures that are needed to prepare the asset for its intended use become part of the acquisition cost. So let's say you buy a building for $100,000, but then you have to do $50,000 worth of work to get that building updated for its intended use. Well, that $50,000 is then going to be built into the original acquisition cost of that building. So let's keep moving forward. If we're talking about machinery and equipment, there could be lots of things that go into the value of that machinery. So again, obviously, the original purchase price, any taxes that we have to pay, whether it's sales taxes or any other type of governmental type of tax, those original taxes that we pay go into that original acquisition value. If we have to transport the machinery to our place of business to get it ready for its intended use, the charges that we pay for transportation go into that original cost. If we have to insure that asset, that insurance also goes into the acquisition cost. Once we have the machine at our building, we then have to install it, assemble it, and test it. All of these things are how we are preparing this asset for its intended use. So all of these costs would be built in to that acquisition value or that original cost. Moving forward, if we're talking about buildings, there's various things that go into the purchase of a building. Obviously, if we purchase it, that cost of the building is part of its original cost. If we construct the building, the cost of construction. If we pay any type of brokerage fees or real estate fees, all of those are required in order for us to get this building ready for its intended use. The same as taxes, any legal fees, title fees, all of those are relevant to getting this building ready. So we're going to include those in the value of our original cost. Let's talk about land improvements. We purchase a piece of land, but then we can make improvements upon that land. These are examples like parking lots, driveways. If we put any type of fencing system, walkways, landscaping, or lighting systems, anything like that, these land improvements are going to be added to the value of your asset. When we get into depreciation, we're going to talk about the difference between how we depreciate something, how we deplete something, and how we amortize something. These are all different terms for recognizing the loss in value over time. And we'll use each of those terms depending on what type of asset that we are depreciating. I want to touch on this while we're talking about land improvements. Notice here we're talking about depreciation of our land improvements. I want to note that land is one thing that typically does not decline in value. So if you think about purchasing a plot of land, the actual land, the ground or the earth, does not depreciate because that value stays the same, and oftentimes land actually increases in value over time. However, I want to differentiate between land and land improvements. Land improvements are the things that we do to the land. For example, we put a parking lot. The parking lot does decrease in value over time. Therefore, we will depreciate the parking lot. However, the land upon which the parking lot is on, we will not depreciate that land because, in truth, the value does not decline over time. And we'll get into that as we move forward, but I just wanted to touch on that while we were talking about land improvements here. Now, when we talk about land, we still have to accurately record the original cost or the acquisition value of that land. However, keep in mind that land is not depreciated. So again, we want to make sure we have it on our books at the correct original cost, but we don't have to worry about depreciating land. So just like our other long-term assets, there are additional costs that can come into play when we purchase land. The purchase price, again, any type of real estate commissions, any type of title insurance or title and transfer fees. If we have survey fees or if there are any kind of delinquent taxes that the previous owner needed to pay but had not, if we're going to be the ones that pay that, all of those costs are going to go into the original value of that land. Now, it's very important to get your original value correct because that original cost is going to be the cost that these assets are on your books at. So let me just go back just a little bit. So, for example, with land, if we purchase land for $100,000, we paid $5,000 in real estate commissions, and then let's say all of these other fees and things, let's say that those were another $20,000. Our original cost would be the sum of those items, $100,000 plus $5,000 plus $20,000. So this land would be on our books as $125,000. So that is the value of our asset. Then, if we're talking about any other long-term assets, for example, land improvements, buildings, or machinery and equipment, all of these things would have that original cost. And then it is that original cost that we begin to use to calculate our depreciation. So we need to get our original cost correct because, remember, that's the value that goes on our assets, and we want to make sure we have that proper. And then also, if this is an asset that needs to be depreciated, it is that original cost that we will begin to build our depreciation models from. So again, we mentioned depreciation, and we basically have 3 different ways to recognize the loss in value over time for any type of these long-term assets. Now, when we're talking about our property, plant, and equipment, we will be depreciating these, and that's just the term that we use to recognize the loss in value. When we move forward, and we'll look at this specifically, if we're talking about natural resources, so this is as opposed to property, plant, and equipment. Natural resources could be, let's say that we have a mine, and the natural resources within that mine are, for example, copper or gold. We do not depreciate a natural resource. We will learn as we move forward that rather than calling that depreciation, we have another term, and that's simply depletion. The method for calculating depletion is not much different from one of these depreciation methods that we're going to learn, but it's just important that you recognize that we have a different term. Finally, we're going to move into a type of long-term asset called an intangible asset. If you'll remember, we talked about property, plant, and equipment, And one of the first things that defines property, plant, or equipment is that they are long-term assets that you can touch, meaning they have physical substance, for example, a car or a piece of machinery. Then we have our natural resources, for example, some type of a mine or water. It's a natural resource versus a man-made type of resource. And those items are depleted. Then we have our intangible assets. These are long-term assets, but they are intangible, meaning you cannot touch them. Their value is not something you can touch. However, they are assets, and we call these intangible assets, and an example of these would be something like a copyright, a trademark, a patent, something like that. It's some type of intellectual rights to something. There's value, and therefore it's an asset, but it's an intangible asset. Now, when we talk about intangible assets, we do not depreciate them. We do not deplete them. However, the term that we use here is amortization, and we'll define amortization as we move forward. But I just want you to go ahead and begin to understand the difference in these terms. Now, the basic calculations are really not all that different, but the terms are important, and it's important to understand that when we're talking about depreciation here, we are only talking about our property, plant, and equipment, these tangible, man-made type assets. So first, let's look into what we call a lump sum purchase. And this is very typical when we're talking about the purchase of property, plant, and equipment. And a lump sum purchase is simply, another term for this is a basket purchase, meaning you pay one price for a basket of items. This is very common oftentimes when you talk about purchasing a building or a house. When you purchase a building, you may have a purchase price of, say, $100,000. But along with that building, you're also getting the land that that building is sitting on. So when you put this on your books, you need to recognize that although you paid for these in one lump sum or basket purchase, we got two specific and individual assets, and we have to recognize both of those assets on our books. Oftentimes when you get a lump sum or a basket purchase, you generally are able to purchase the two assets at a lesser value than what you could have gone out and bought them if you were purchasing them separate. So the question here is how do you know how much of your cost to apply to which asset? So let's look at an example. CarMax paid $90,000 of cash to acquire a group of items. So we've got land that was appraised at $30,000, land improvements appraised at $10,000, and a building that was appraised at $60,000. When we talk about an appraisal value, this is the fair market value. So we're saying, had you gone out and bought each of these things separately or paid for them in separate transactions, this is what you would have paid. So the sum of these is $60,000 plus $30,000 plus $10,000. So the fair market value of all of these assets is $100,000. However, we only paid $90,000. So the question is now, if we understand the principle that tells us we have to put our assets on the books at historical cost. So we know, what did these all cost us? In total, they only cost us $90,000. However, we know their fair market value is $100,000 altogether. However, based on that principle of historical cost, we cannot put them on our books for any more than what they cost us. So what we can do is we can separate the cost based on the relative fair market values of these assets. The way we do this is we look at the total fair market value of these three assets added together, and that's $100,000. And then we look at the percentage that each one of these makes up of that $100,000 fair market value. So for the land, of the total value, $30,000 of that is land. So 30% of the fair market value is allocated to the land, 10% to the land improvements, and 60% to the building. What we then do is multiply those relative fair market value percentages to the overall cost of the overall purchase, and that tells us how much we should put on the books for each asset. So you can see here 30% multiplied by that cost of $90,000 tells us that we should put $27,000 of value onto the land, $9,000 for the land improvements, and $54,000 for the building. It's very important to get this correct because if you have these incorrect, it's going to affect your depreciation. Remember, we do not depreciate land, but we do depreciate our land improvements and building. And furthermore, we may use different methods or different lifetimes in order to depreciate these different assets. So although we have a total of $90,000 put on our books, it's also important to get these different values correct. And we do that, like we just showed, using their relative fair market values. So now let's get into depreciation. As I've mentioned, depreciation is simply the process of allocating the cost of a plant asset and expensing that through the accounting periods in which it was useful, or in other words, whenever this asset was being used to make revenue, we want to match the expense that shows the wear and tear on this asset. And we do that through recognizing depreciation. So keep in mind that when we're looking at depreciation, this is a type of expense. So when we originally put an asset onto our books, we're putting it onto our balance sheet because it is an asset and assets are on our balance sheet. Then, as we recognize our depreciation expense, we're going to affect both our balance sheet and our income statement. And we'll do that through the journal entry that recognizes depreciation expense. We'll get into that as we move forward. But let's look at how we actually calculate depreciation. We need to know three things in order to calculate our depreciation. First, we have to know the acquisition value, or that historical cost that we were looking at a previous slides back. So remember, keep in mind that rule that all of the costs that were required to get your asset ready for its intended use, all of those items go into the cost of this asset. Salvage value. This is a new term, but if you think about any type of piece of equipment, you're using it in your plant, and you've used it for, say, 10 or 15 years, and now it's no longer useful. Rather than just throwing it in the dump, oftentimes companies can resell a piece of old equipment to someone else. Maybe you sell it to a junkyard, and then they take off the metal and various pieces of equipment that still have some type of value. Or maybe you sell it to someone else who still can use this machinery in whatever their process is. So the value that you can get from selling something that's no longer useful to you is your salvage value. This is important because it helps to offset part of that original cost, and we'll look at that when we get into our actual calculations. Finally, you need to know the useful life of whatever it is you're depreciating. Useful life is determined by management, but I'll give you a basic understanding of useful life. Think about a building. A building typically lasts for a while. It may be a building that you think will be around for 30 years, or maybe it'll be around for 20 years, but it has a longer life. Think about a computer, a piece of technology. Yes, a computer will hopefully last for more than a year, and that's why we call it a long-term asset, but it's not going to last for 30 years. It probably won't even last for 5 years. It may have a life of only, say, 3 years. So our useful life is something that is determined by management, but you have to make sure that that useful life is a true picture of how long an asset is going to be helpful to you. So these are the things that we need to know. We have three basic methods of depreciation: straight line, units of production, and declining balance. I mentioned that once we learn the methods of depreciation, you already will understand the calculations when we get to depletion and amortization. I'm going to go ahead and show you. Right here, when we're learning units of production, this is the same method that we will use when we are depleting our natural resources. We'll look at actual examples, but go ahead and keep in mind that this units of production can be used to depreciate our property, plant, and equipment, or it's what we use when we are depleting a natural resource. On the other hand, straight line depreciation, this can be used for depreciating our property, plant, and equipment but it's also what we use when we are amortizing an intangible asset, and we'll look at that once we get to those. So we'll be looking at all of these methods as we move forward, but we're going to use one basic example, and let's go ahead and look at this. We have an asset that originally cost us $10,000. The salvage value, or that scrap value at the end of the life, is $1,000. The useful life is 5 years, and then the units that we will be able to get some value from are 36,000 shoes. So 36,000 units. All of this information is going to be helpful for using these different types of depreciation methods. First, we're going to go into straight line depreciation. Again, here's a summary of our information. To calculate straight line depreciation, we're simply going to calculate the value that we will be depreciating every year for the next 5 years. So once we calculate our straight line depreciation, we know what it will be every year for the next 5 years. Our other methods, units of production and our declining balance, those are going to change from year to year. So the straight line method is typically the easiest method. So the basic idea here is we're going to take our cost minus any salvage value and divide that by the useful life. So here, $10,000 minus $1,000 divided by 5 years. The reason we take out this $1,000 is because, remember, at the end of its life, we're not going to fully depreciate this because there will be a little bit of value left over at the end. When we use this asset for 5 years, it's not going to have a value of 0 at the end of that 5 years. It still has a value of $1,000 because we're going to sell it for $1,000. So there's no reason in depreciating that last $1,000. So we take that out of our numerator up here. So $9,000 divided by 5 years tells us that we will depreciate $1,800 each year for the next 5 years. The way we recognize depreciation is through the following journal entry. We recognize an expense, and we call it depreciation expense. This is just like any other expense. It'll be as an expense item on our income statement. And the other side of this transaction is to recognize a type of contra asset. Remember, anytime we have an account that we call a contra account, that means it does the opposite of whatever account it goes with. This is a contra asset, so it works the opposite way of a regular asset. When we are crediting accumulated depreciation, this is recognizing an increase in this contra asset account. If you remember, a regular asset increases with a debit, so a contra asset would increase with a credit because it works the opposite way. And what this contra asset is it is an offset to our property, plant, and equipment for this piece of machinery. What we'll do when we show our balance sheet, we will show that the original cost of this asset was $10,000, but after year 1, we have $1,800 of accumulated depreciation. This accumulated depreciation will add up over the next 5 years until at the end of the 5th year, we will have $9,000 of accumulated depreciation in that contra asset account. So here we have our straight line method. You can see here we're going to have the same amount of depreciation expense each and every year. So $1,800 of depreciation expense. And then if we look at our balance sheet, we can look at the book value or the carrying value of that asset. The carrying value of the book value is that net value, which is its original cost, minus accumulated depreciation. So when we first bought that asset, it had a value of $10,000. But then once we used it over the first year, we'll need to recognize $1,800 of depreciation. So at the end of 2015, we have $1,800 of accumulated depreciation, and therefore you can see the decline in the book value of our asset. Then, for example, if we go on yet another year, we have 2 years of accumulated depreciation. So 2 years multiplied by $1,800 is $3,600. So you can see here the book value of our asset has declined yet again, and at the end of 2016 the book value is $6,400. That book value will continue to decline until the end of its life, when you can see here the book value is $10,000 minus $9,000 of accumulated depreciation for a book value of $1,000 at the end of its useful life. So here we just have a basic schedule showing our straight line depreciation. The most important thing here is to note that with straight line depreciation, we're going to have the same amount of depreciation every year for each year of this asset's life. We're now going to move into units of production. What's important here is that our numerator is the same. It's still going to be the cost minus any salvage value, but then we're changing our denominator. Rather than looking at how long this asset will last in terms of years, we're talking about how useful is it in terms of how many units of use will we get. So if you'll remember a couple slides back, we were given all of this information, and so we simply need to plug this in to our calculation. If you'll remember, our depreciable cost is $9,000, so our numerator is going to stay the same. And then the total units of production, or the total life that we think we will get out of this asset, is 36,000 units, or 36,000 shoes. So what this tells us, 9,000 divided by 36,000, is that for every unit we produce, or every unit we inspect, in this case, as this is a machine that is inspecting our shoes, we will depreciate the value of this machine at 25 cents per unit. So using units of production, we have to come up with our depreciation value per unit, and then we use that per unit amount to calculate our depreciation based on how many units were produced, or in this case, how many units we inspected each year. So the way we calculate that, our depreciation expense for the year is going to be the depreciation per unit, which is 25 cents per unit, multiplied by however many units we inspected. In this case, for the first year, we inspected 7,000 units, so we put that into our equation, multiply 25 cents by 7,000 units, and you can see here that tells us that we need to depreciate $1,750. We would then do this for each and every year based on how many units we inspect to come up with our depreciation for the year. You can see here we went from 7,000 to 8,000 to 9,000, and then we began to decline back to 7,000, and then finally 5,000 units that we inspected throughout the life of this product. You can see here our depreciation expense varies with the number of units that we inspect. You can see, as you would expect, that when we inspect more units, our depreciation expense for the year increases. And then as we begin to decline to 7,000 and then 5,000 units, our depreciation expense declines along with that declining use. We can still calculate our book value at the end of each year. Remember, the book value is going to be the original cost minus your accumulated depreciation. So you can see here again, for example, at the beginning of this, we had a book value of $10,000. And then after the first year, we had depreciation of $1,750 worth. So the book value after the first year was $8,250. Then if we move on and look, for example, at the end of this life, so at the end of 2019, you can see here we have depreciated a total of 36,000 units of use, which is the full amount we expected to use. So when we add up all of our years of depreciation, you can see that we have 9,000 of accumulated depreciation, leaving us with an ending book value of $1,000. If you compare this with our straight line depreciation, the big difference here is the change in the variance in our depreciation expense. And that's simply because this is dependent on how many units we produce. because the number of units drives the value of our depreciation expense for each year. So you can see an increase or a decrease in your depreciation expense each year simply based on the use of this property, plant, or equipment. Move into the double declining balance method. This method is very different from the previous two methods, so we're going to work through it together. The first thing I want to note is the importance of the name. It is the double declining balance method. And what does it mean? What is it the double of? The answer is that it is the double of the straight line percentage that we would be depreciating if we were using the straight line method. So let's talk about that. In the previous examples, we have been using a life of 5 years. So if we have a life of 5 years, that basically means that every year we are depreciating 20% each year, because 100 divided by 5, 100 for 100%, divided by 5 tells us that over 5 years, if we are going to be depreciating an equal amount each year, that means that's 20% each year. So our double declining method is simply going to be double the amount that we would be using if we were using straight line. So let's look at this. Multiply 2 by the straight line rate, which is 20%. 2 multiplied by 20% equals 40%. So when we complete the double declining balance, we are going to be depreciating 40%. But 40% of what? We're going to be depreciating 40% of the beginning period book value. So at the beginning of the life of this asset, it had an original cost of $10,000. So the beginning period book value for year 1 is $10,000. We do not take into account the salvage value when we're using this method. Now, as we move forward, once we get into the later years, we will not depreciate beyond $1,000, but we're not using the salvage value in our actual calculation. So here, to calculate our depreciation for the first year, it's 40%, or double the amount that we would be depreciating each year if we were using straight line. So 40% multiplied by 10,000, because that's the beginning period's book value. Now what's going to be important is that when we begin the next year, the beginning period book value for year 2 is not 10,000. It's going to be 6,000, because that's 10,000 minus the accumulated depreciation. So when we're calculating for the next year, it's not 40% multiplied by 10,000 again. It's going to be this double declining rate multiplied by 6,000. Now we want to note, why would we even use double declining? It seems more complicated, but it is very useful. What the double declining method does is, and when we compare this to the other methods, you'll see that we're going to have the most depreciation in the beginning, because we're going to be depreciating our percentage on a larger original cost. So our depreciation in years 1 and 2 is going to be more than it would be in years, say, 4 and 5. So you're going to see the amount of depreciation decreasing as we go on. I'm going to go back to the example about a car, or a computer is a good example. Something like a brand new car, it depreciates the most as soon as you drive it off the lot. It depreciates the most in those early years, meaning the value drops the quickest in the early years. The same with a computer. It has a very short life, and it loses its value very quickly up front. So these are different areas where the double declining method makes sense. So even though it is more complicated, it's still important. So the double declining method, once we calculate that double declining depreciation rate, it's going to be the same for each year, 40%. But what changes is the beginning period book value. That's where we said for year 1 it's 10,000. For year 2 it's going to be our original book value minus any accumulated depreciation, which was 4,000. So 10,000 minus 4,000 gives us 6,000. So then when we calculate our depreciation for the year 2016, it's going to be $6,000 multiplied by 40%. Then our accumulated depreciation at the end of year 2016 is going to be the sum of the two previous years. So we would have accumulated depreciation of $6,400. And then you'll see that's where we get that beginning book value for year 2017. It's $10,000 minus all of that accumulated depreciation. So as we move forward, this is how we complete our calculations. Now I want to note here in 2019, you can see here we have a star, this little asterisk, and what this is telling us is that during the year 2019, we hit our salvage value, meaning we come to a point where even when we calculate what our depreciation should be based on $1,296 multiplied by $40, we know we're not going to depreciate beyond that salvage value. So at the beginning of year 2019, we had a value of $1,296. If you'll keep in mind, our salvage value is $1,000. So no matter what our depreciation calculates to be, we are not going to calculate beyond $296. Because if we depreciate anything more than $296, the value of our asset would drop below $1,000. And that wouldn't be a true reflection of the value of this asset because we know we can sell it for $1,000 for its salvage value. So no matter what our depreciation calculates to be, we will stop depreciating once we hit that salvage value. So even though we're not using the salvage value in our original calculation using the double declining method, it doesn't mean that we ignore it. Instead, we have to pay attention to that when we get to these later years, and we make sure that we do not depreciate beyond that salvage value. The book value should never fall below that $1,000. Here we just have a little comparison about our different methods. You can see here we had straight line, units of production, and double declining. The main things that I want to note here is that straight line, you're going to have the same amount of depreciation each and every year. Units of production, your depreciation could increase or decrease from one year to the next, depending on how much your particular asset was used. Because remember, the more we use an asset, the more we would depreciate using units of production. And then finally, with double declining balance, you'll notice here that our depreciation expense is going to be highest in the first year, and then it's going to decline from there. So now that we've talked about our basic depreciation, let's talk about what happens if we have a partial year of depreciation. The bottom line is that our basic calculations are the same, but then we just have to modify our answer by whatever percentage of the year has passed for which we want to depreciate. So let's look at an example here. We have a company and assume that they purchased this piece of machinery on October 8th. So we're not going to be calculating our depreciation for the first year for an entire year. Instead, it's only going to be for the last 3 months of the year, October, November, and December. So if we want to calculate this and we're using straight line depreciation, our basic calculation is still the same. We've got our cost minus our salvage value, and simply divide that by the 5 years of its useful life. Now, the key here is this calculation is based on the understanding that we would be depreciating for a year. We're not depreciating for a full year yet. Instead, we're only depreciating for 3 months. So we can simply multiply this answer by 3/12. And this tells us that the amount of depreciation for those 3 months is $450. So moving forward, let's talk about another thing that can happen, and this does happen fairly often. Keep in mind that depreciation is an estimate, and there's a couple estimates involved here. First, we have to estimate what we think the useful life of a particular asset is. Typically, companies have general guidelines. For example, some companies have the general rule that any type of a building has a useful life of, say, 30 years. I used to audit a company that had a lot of stadiums, and their buildings were 30-year lives, but their bleachers They were a horse racing facility. The bleachers, they said, typically lasted for 20 years. And then when we move into things like cars, you typically look at things more of a 5-year life, 5 to 7 years. And then if you're looking at technology, it could be anywhere from 3 years to 2 years. But these are predictions. No one knows exactly how long a particular asset will last. Once we get into using an asset, you may see, oh, you know what, the quality of this asset was not what we expected, and therefore we think it won't last the 30 years that most of our buildings typically last us. So we may need to adjust our useful life. Another thing that's an estimate is that salvage value. Remember, if we have an asset, in our previous example, we had an asset we purchased for $10,000, and we said it would have a salvage value of $1,000. That is our prediction of what we can get someone to buy that old asset for. It may turn out that it's more valuable than we thought, and we could actually get more. Or it may turn out that the market for that asset, that maybe it's scrap metal or whatever it is you're going to sell it for, has decreased, and that salvage value is going to go down. It is fine to have a change in your estimate. However, when we do have a change, we have to make sure that we properly account for that. Basically, what we'll do is we'll simply incorporate this information into our calculation and come up with a new calculation. So let's look at this. We had our previous example, and let's say that we come to the 3rd year. And at that time, we had a book value. Remember, book value is your cost minus your accumulated depreciation of $6,400. And at that time, it's determined that the machinery will have a remaining useful life of 4 years, and that the estimated salvage value will be revised. So what's happening? First, we're saying we originally thought that this asset would last us 10 years. But now we're at the beginning of the 3rd year, and we know it's only going to last another 4 years. So in truth, we're only getting 6 years out of this asset because 2 years have passed, and now at the beginning of the 3rd year, we see it's only going to last us about 4 more years. So the useful life is going to go down. We also see that the salvage value is not as high as we thought it would be, so we need to reduce that to $1,000. What we'll do is we'll create a new depreciation calculation based on the information that we have. So now, rather than using our original cost, we'll replace that with the current book value of $6,400. We'll put in here our revised salvage value, and now we put in the remaining useful life. Remember, before we were dividing by 10 years because we thought we had 10 years of useful life. Instead, we see now, in truth, in total, we're only going to get 6 years of useful life. But at this point, 2 years have already passed, so the remaining useful life is only 4 years. So now you can see that we are going to have a new depreciation amount of $1,500 per year. So anytime we have a change, we just start over, we make a fresh calculation, replacing our numerator rather than using our original cost. That's going to be our current book value. If we had a change in the salvage value, we would show that here, and make sure that you only include the remaining useful life, not the full revised useful life, but only the portion that remains. And then we would just depreciate from there. A quick note on how we report our depreciation. Reporting depreciation is going to come in 2 places. It's going to be on our balance sheet and on our income statement. On our income statement, it's simply another line item as an expense. But let's look at a snapshot of our balance sheet. This is our balance sheet, and this is the portion of our long-term assets, those assets that are going to last for longer than a year. And what you can see here, we have some various assets listed here, and then we have a new line item. This is less accumulated depreciation. So any accumulated depreciation related to these above assets is going to be shown here. We're going to sum all of those together. And so then we have a net balance for our property, plant, and equipment. that net balance is going to be the sum of the original costs of all of these assets minus their related accumulated depreciation gives us that net book value. So this is very important that we'll show the accumulated depreciation on our balance sheet. Make sure that you're not showing depreciation expense on your balance sheet. Remember, depreciation expense is only going to be that yearly expense, whatever the expense was for that year. But accumulated depreciation is going to be the sum of all the previous year's depreciation expense added up, because that is the accumulated portion. When we're talking about property, plant, and equipment, we need to discuss additional expenditures. Anytime you purchase one of these long-term type assets, we call that a capital expenditure, meaning this is a large expenditure on property, plant, and equipment. So I just want to show you the difference between a capital expenditure and a revenue expenditure. When we have a typical expense, these are the expenses that we've looked at previous, whether it's a salary expense or some kind of tax or interest expense, we are going to go ahead and expense this as soon as we incur those costs. This is what we've been learning throughout the term. However, if we have a capital expenditure, these expenses are not immediately expensed. So let's think about if we spend money on property, plant, and equipment. We are originally going to show those as an asset on our balance sheet, and then we will expense it in the future, and we do that through depreciation expense. But what we're talking about here are additional expenditures. So what happens if we purchase a building and then 3 or 4 years down the road we spend more money on that building? What we need to determine is that additional expenditure on our capital asset or that building, is that going to be a revenue type of expenditure or a capital expenditure? And there's a basic rule here that's going to answer that. If we have any type of ordinary repair, these are just ordinary repairs and maintenance that come up. Any type of ordinary items are going to be a revenue expenditure, meaning we go ahead and expense that in the period in which it's incurred. On the other hand, if this is money that we pay to either make our building or our property or plant or equipment better in some way, that is going to be considered a capital expenditure, meaning we add that to the value of whatever asset we have bettered. So if we have really overhauled or replaced something, and if these are expenditures that are going to extend the life of our asset, we will consider these capital expenditures. So let's think about if we had a building that we purchased a couple years ago, and then we had some type of storm, and we had to totally replace the roof. That is not an ordinary repair. That is a major overhaul or a total replacement of the roof. And when we do that, not only does that have a huge impact on the value of the building, but we're also going to extend the life of that building by increasing the value of the roof that protects it. So that is a capital expenditure. Let's say, on the other hand, we have a plumber come in, and he comes in and he tightens some bolts and maybe adjusts a couple lines in our plumbing system. That is not a major overhaul. That is just typical wear and tear. It doesn't do or add any value. It simply is typical ordinary repairs. That would be a revenue expenditure, and we would go ahead and expense that in the period when that expenditure was incurred. Moving forward, we're going to look at the end of the life of a plant asset. So this is after we have used an asset and it's the end of its useful life. How do we dispose of that asset? Now, when we dispose of an asset, we could dispose of it because it is simply an old asset and it's no longer useful. So that's when it's truly at the end of its useful life. Or, let's say we have a building, we thought we were going to keep it for 30 years, but for some reason we've changed our mind. It's not that the building is no longer useful because it's just worn down. It's because maybe we found a building in a better location. So we can also dispose of a plant before its useful life is over. So we're going to look at all of these different scenarios. So whenever we're going to dispose of a plant, the first step is we have to update depreciation to the date of disposal. So rather than leaving our depreciation as it was at the end of the previous year, we need to bring it up to date. So let's say it's the year 2016, and let's say that we decided on April 1st to sell a building. Then we need to go ahead and record depreciation for the depreciation that has already incurred. So we had depreciation for January, February, and March. I said this was April 1st, so we're not going to depreciate for April. We're just going to depreciate for those first 3 months. So we would do a partial year depreciation calculation for the first 3 months of 2016 to bring the depreciation up to date. Then we have to actually journalize our disposal. We will record if we get any cash that we either receive or if we pay it. And then we'll need to make a record if we have a gain or a loss. And we'll look at those as we look at some examples on the next couple of slides. And then finally, now that we've sold the asset, we have to totally remove it from our books. So that means we need to remove the original cost from our books. And we need to remove whatever accumulated depreciation we have related to that particular asset. So one of the things that I mentioned is that whenever we discard a plant asset, there's the possibility of having a gain or a loss. The way that you know if you get a gain or if you have a loss is you simply compare the value of what it is that you get to the value of what you are discarding. So here, if we're getting cash, if we get more cash than the book value of what it is we're getting rid of, that would be a gain because we are getting more value than what it is we're giving up. You record a gain as a credit. You can keep in mind that a gain works very similarly to revenue. A gain is not revenue, so don't call it revenue. But to help you remember the rules for gains and losses, remember that a gain increases with a credit, the same way revenue increases, and a loss increases with a debit, the same way you would record an expense. So then if the cash or whatever it is you get is less than the book value of the asset that you're getting rid of, you would be recording a loss. If the value of what you get and what you give up is equal, then there would be no gain or no loss. So let's look here. We had a machine that originally cost us $9,000 that was fully depreciated as of the end of the previous year. So we don't need to update any kind of accumulated depreciation because it's already fully depreciated, and now we are actually writing this off, meaning we need to take it off the books. So the machine was originally on our books at $9,000. Remember, the machinery is an asset, so it was on our books as a debit. So to get rid of it, that's why we are crediting machinery. If it was originally on there of $9,000 as a debit, a credit of $9,000 will bring that value to zero because now that we have discarded this plant asset, we don't need it on the books, so the value should be zero. We also need to take off all of the accumulated depreciation related to that asset. Because we no longer have the asset on our books, there's no reason to be keeping track of that accumulated depreciation. We need to get rid of that along with the asset that it was related to. If you'll remember, accumulated depreciation is a contra asset, and so it was on our books as a credit. So to get rid of it, we're simply going to debit the account, and that'll bring both of those accounts to zero to show the fact that we no longer have this asset. So now let's look at another example. We have some equipment that originally cost $8,000, and it had accumulated depreciation of $6,000 on December 31st of the previous year. We have decided to discard this asset on July 1st. So what we can see here already is we're going to need to bring our depreciation up to date because we have only depreciated it up to December 31st of the previous year. So now we need to go ahead and depreciate it for the first 6 months of the current year because we're getting rid of it on July 1st. So the company had been depreciating the equipment using the straight line method over 8 years with zero salvage value. So first, let's bring that depreciation up to date. Our depreciation would have been calculated as the original cost minus any salvage value. We had no salvage value, so minus 0, divided by 8 years. So that's basically $1,000 of depreciation each year. Now we're at July 1st, so we're only going to depreciate it for the first 6 months of the year, for June all the way back to January. So $1,000 multiplied by 6/12, or 1/2 of a year, is $500 of depreciation. So now our depreciation is up to date, and we can get the asset off of our books. Let's go back and look. This asset is being discarded. So we're not selling this asset for anything. We're not trading it for anything. We're simply getting rid of it. So we need to take the asset off of our books. So you can see here we need to take off the accumulated depreciation. Remember, it was originally $6,000 of accumulated depreciation, and we added another $500. So $6,500 in accumulated depreciation comes off. And then we take the full amount of the equipment off for $8,000. You'll see here that $6,500 and $8,000, those do not balance. We know that we need another $1,500 on this debit side. And it makes sense. Remember, a debit gives us a loss. And let's talk about why it makes sense that we have a loss. We are getting rid of a piece of equipment that still had some sort of value. It still had $1,500 of value. That was the difference between the original value of the equipment and its accumulated depreciation. Because we weren't selling this to anyone, we didn't get any kind of cash payment for this. We simply discarded the asset. We need to recognize that we have lost this portion of the value. So you may be wondering, why would someone discard something if they're going to have a loss? The bottom line is, yes, they're going to have a loss, but they might be discarding this asset because they're purchasing a much better asset that's going to be more efficient, less costly to run. So that's beyond this class. That's the type of thing that you'll look at in Accounting 102. But the bottom line here is that it's very common for plants or for companies to get rid of an asset even though it has a value left, and you recognize that as a loss of whatever value was left. So now what happens if we sell a plant asset? We have equipment that originally cost $16,000 and it had accumulated depreciation of $12,000 at the end of the prior year. Annual depreciation of this equipment is $4,000 using straight line depreciation. And so we are going to sell this equipment for $3,000. And we're doing this on March 31st. So the first thing is we always have to bring the depreciation up to date if we're dealing with a partial year, and in this case we are. We don't have to calculate what our straight line depreciation amount is because they've already told it to us. It's $4,000 per year. Now, as of March 31st, only 3 months have passed. So $4,000 for 3/12 of the year is going to tell us that we need to update our depreciation for $1,000 of depreciation expense and accumulated depreciation. So now we need to take the asset off of our books, and we need to recognize the cash that we got, and then we can look to see if we have any type of a gain or a loss. So first we'll take the asset off of our books. We originally had $12,000 in accumulated depreciation. We added another $1,000, so that was a total of $13,000 in accumulated depreciation. We take the equipment off of our books for the original value of $16,000, and then we recognize the fact that we got $3,000 of cash. You can see here $3,000 plus 13 equals 16. So in this case, we are in balance. So there is no gain or loss. So what happens now, same scenario, but now instead of getting $3,000, what happens if we only get $2,500? First, we update that depreciation, and nothing has changed here, so we'll leave that the same. And let's go ahead and write down what we have. We take the accumulated depreciation and the equipment off of our books for those same values, and then we recognize our cash of $2,500. But $2,500 plus $13,000 equals $15,500. That does not balance with our credit over here of $16,000. So we need a debit of $500. If you'll remember, a debit works like an expense, so we've got a loss here, a loss on the disposal. And why is that? Let's talk about this. You can see in this previous example that the value left in this asset is $3,000 because that's the difference in the original cost and the current accumulated depreciation. So when we got cash of $3,000, we were paid exactly the amount of value that was left, so there was no gain or loss. But if we get less than $3,000, that means that we are getting less cash than the value that was left in that asset. So the difference between those is going to be the loss that we recognize of $500. We're now going to move into natural resources. We've already talked about the method that we're going to use to deplete natural resources. So this really is not a new section. We're just using a new term. If you'll remember, I introduced the term depletion early on in the chapter. And when we're talking about using up our natural resources, we will call it depletion rather than depreciation. We use depletion when we are extracting some type of natural element from the earth. So this could be examples of oil, coal, gold. If you're in some type of a forestry type of company, as you cut down the plants in the forest, you would be depleting that natural resource. And we have to show that when we purchase some type of natural resource, whether it's some type of coal mine or gold mine, or if it's a forest, we purchased it because it has that value to our specific company. And as we use that value up, we have to show that that is an expense. And we call that expense depletion when it's a natural resource. This is going to be very similar to the method that we were doing with units of production. So let's look at this. So we have some type of mineral deposit that has an estimated 250,000 tons of ore available. And we purchased it for $500,000 with zero salvage value. You're going to recognize this formula. Cost minus salvage value divided by the total units of capacity. Very similar to what we were doing with units of production. So 500,000 minus 0 divided by the total number of tons tells us that as we deplete or use up these tons of ore, we are going to deplete those at $2 per ton. So we need to know how many tons we extract in a particular year to come up with our depletion expense. So if we extract 85,000 tons, we would multiply that by the $2 per ton, and that tells us that we had a depletion expense of $170,000. So just like the units of production, we're going to see an increase or a decrease in our depletion expense based on the activity that we have and how much we consume of this particular resource. So depletion expense, when we record this, it works very similar to depreciation. The terms are just different. You can see here depletion expense for that $170,000 and then accumulated depreciation of $170,000. We would also keep this on our balance sheet just like we do with depreciation. So we have as a long-term asset, we have this mineral deposit of $500,000. We show any related depletion. And then here you can see the remaining book value for that natural resource, or in this case, the mineral deposit. Finally, we're going to touch briefly on intangible assets. I mentioned in the beginning of this chapter that an intangible asset is an asset that has value, but you don't touch the value of that asset like you can touch a building or a piece of machinery. An intangible asset is typically some type of asset that provides some type of right or privilege. One of the easiest ways to explain this would be a patent. So, for example, if you have some type of expensive or a very valuable formula for making whatever it is you make, you can go out and get a patent that gives you the exclusive rights to that particular formula. Now, when you get a patent, yes, you get a piece of paper that represents that patent, but it's not the piece of paper that is valuable. It is what that piece of paper represents that has value, and that's what we're talking about when we talk about the intangible asset. It is the value of that formula or whatever it is protecting. Now, we've got lots of examples of intangible assets, and oftentimes it can be difficult to determine a useful life, or if you have things like copyrights or trademarks, there are specific legal lives that we have to look at. So, for example, if you have a copyright, oftentimes there is a certain amount of years beyond someone's life that copyright is still useful. So when we get into intangible assets, sometimes the useful life is harder to determine. So some examples of these things are patents, copyrights, franchises and license, trademarks, goodwill, leases, lease improvements, and then there's many more. Now, intangible assets can have what we call a finite life or an infinite life. An infinite life means that the life cannot be determined. That life could go on forever. Or a finite life means it has a specific defined life. And I'm not going to require you to memorize all of those. But for example, patents, copyrights, franchises, it could have a 20-year life, a 30-year life. It's just determined by the contractual terms. So, if something has a finite life, meaning we can define the life, then we will amortize it. You can do this through just very much like straight line depreciation. You would take the value. These typically don't have any type of salvage value, so you don't have to worry about that. And divide that by whatever their defined finite life is. So if you had a patent that was, say, a $100,000 patent, and it was going to last for, say, 10 years, just to make things easy, that would tell us that we would have $10,000 of amortization each year. So that's just a basic example. Now I also want to touch on, for example, goodwill. Goodwill is one of these types of intangible assets that has what we call an infinite life, meaning that this has no defined life, so we will not amortize it. Instead, we do something called testing it for impairment. Goodwill is something that is beyond what we're talking about right here, but if you purchase a company, you are purchasing the value of that company name in addition to the net value of the assets minus the liabilities of that company. So let's just throw it out there. Let's say that you decide to purchase the Coke company. Let's say the net value of the assets minus the liabilities of Coke is $100,000. I know, of course, that that's very low, but let's just say it's $100,000. You could not buy a company like Coke for the net value of those assets, so say for $100,000. Even though on the books that is what Coke would be worth, you couldn't buy it for $100,000. You might have to pay $1 billion. And why is that? That's because you're not really paying for the value of Coke's assets. You are paying for the value of the name that they have built. And that value, the difference between the net book value of a company and what you pay for it, is called goodwill. So we do not amortize goodwill because that's simply the value that you purchase when you purchase a company. So there's no defined life for that. You would test it for impairment. So let's continuing with the Coke example. We had goodwill on our books because we purchased it for more than the actual assets were worth. Let's say for some reason Coke had a huge recall and the recall was too late and they actually gave all of their customers food poisoning. you can imagine that that would hurt the value of the Coke name. Maybe people would start drinking Pepsi instead. So when you hurt the value of that name, we would then need to test our goodwill for impairment, meaning has the good name or that good value been impaired? And in that case, if we determine that it was impaired, we would need to show a loss to that specific asset. Again, what we're talking about here with impairment and goodwill is beyond the scope of this class, but I oftentimes have people in the class asking about goodwill and trying to get a better understanding of what's going on there, but that's basically the idea. So if it is an intangible asset with a finite life, meaning a defined life, you would simply use the same type of calculation that you used when we were doing straight line depreciation. We simply call it amortization rather than depreciation. Finally, we're going to end the chapter with a ratio. You should probably be used to ending these chapters looking at ratios by now. But our ratio here is going to be the total asset turnover. Anytime we're talking about a turnover ratio, we're always looking at whatever the turnover is for, we're looking at, are we turning over that item in order to make sales or to make income? So if it is the total asset turnover, we're trying to get an idea of, okay, this company has purchased a lot of assets. Are they purchasing useful assets? Meaning, are they purchasing assets that are actually producing sales? Because if you have all kinds of assets but you're not producing sales, you are not efficiently using your assets. So just to get an understanding here, you want your net sales to be higher, and then of course the more sales you can make with the less investment, the better off you're going to be, the more efficient you're working with the assets that you do have on hand. So it's safe to say that the higher the total asset turnover is, the more efficiently a company is using its assets.